It is 3 minutes past 10 on Tuesday, the 12th of May. It's another sunny day here in London. We actually had some pretty bad weather over the weekend, but now it seems to be brightening up once again. Clear blue skies out there. Of course, last night there was the halvening did occur, which everyone was watching with some keen anticipation. It actually turned out that the 630,000th block on the Bitcoin blockchain only took 20 seconds to mine, while the previous one was more like 20 minutes. So it all occurred very suddenly. Not much did happen. We saw the price go up yesterday in anticipation, and then sort of sell off afterwards, and it all sort of flattened out. So the price today, at the time of this recording, is $8,750 as an average per BTC, and the price is climbing a little bit today, but we'll see how that all turns out. Now, on today's market broadcast, I have got on Nickolai Hubble, who is the co-author with me over at the Fleet Street Letter Monthly Alert. Nickolai is an expert in all things the Eurozone, but I thought in today's market broadcast we could range over a few other topics that we've been looking at recently. Now, Nickolai, I understand you've been doing a lot of thinking on the topic of, effectively, if the government is keeping everybody afloat and everybody is simply allowed to roll over their debts, what does this really lead to in the longer term for investors? Could you riff around that topic for us and explore it a bit?
Yeah, what I'm trying to figure out here is where the reckoning comes. Where does this all lead to in terms of, we know it doesn't work. Otherwise, it would have just always have been done historically. If money printing and government spending and bailing everyone out works, then we wouldn't really need anything else in our economy, and the government could just run the thing. We know that doesn't work. The question is where the accountability comes true, where the reckoning occurs, and I can't quite figure it out properly. At the moment, we've got a situation where, in order for the companies, especially large ones, to fail, they basically need to fail to pay something. They need to fail to pay a bill, or usually they need to fail to pay their debts. And that can pop up in unusual ways. So, for example, in Australia, I believe it was, the airport actually parked a bunch of trucks around some airplanes to prevent them from leaving because the airline hadn't paid the airport its fees. So, it's an example of, in order for things to start to go wrong, someone needs to fail to pay something. But what you've got now is this weird situation where central bankers and governments are basically covering everyone's bills. They're making sure that the companies have enough money to pay so that reckoning doesn't actually occur. And what I'm trying to figure out here is, well, where does that lead to, and at what point does it have to stop? The first obvious answer is that once the government can't borrow any more money because they've got so much debt already, then they can't help bailing others out. And all of this should really just be described as a transfer of debt and transfer of risk from company balance sheets and from household balance sheets onto the government balance sheet. But what you've also got is central banks printing money to bail companies out. The textbook example of that one was when the Fed bought the bonds from the Carnival cruise ship company to try and keep that a going concern. And my point really here is that once you've got the central bankers printing money infinitely and backing individual companies right down to cruise ship, like leisure businesses, then the reckoning is sort of delayed indefinitely, or it must show up somewhere else. Now, what I'm really asking is, well, what is that something else? And that's what I've been trying to figure out.
Yeah, there's interestingly been the rise in sort of strategic defaults at this time as well, because defaulting on a bond is not quite the same as declaring bankruptcy, but it appears that a lot of companies have sort of used this as a subterfuge to in order to do this and improve their balance sheets that way by defaulting on certain bonds and the like. And it seems that this sort of goes both ways. It's not just the government trying to support all of the bond market effectively and keep all of these companies afloat, but companies at the same time are just responding to the incentives sort of created by the government because they know that they'll be allowed to stay in business one way or another. On your note with where does this show up and how it might show up somewhere else, if this reckoning is delayed, there is an effect that we'll see on that. Where do you think that will show up?
I can't figure it out. I'm thinking through lots of different possibilities, but I haven't got a favorite yet. But going with what you just mentioned, I watched a video recently that's on the news today where some prison inmates, I believe in America, infected each other with COVID-19 in order to be able to be eligible for the early release program. And that's what I think is also going in the corporate bond market in the way that you've mentioned, where companies are making themselves look bad in order to get access to cheaper funding and being able to the strategic defaults, as you mentioned. So I think all the incentives are getting a bit wacky and weird. And perhaps that's what's leading to the first thing that I've noticed about where is this reckoning going to come from in the end. And I think it's a stagnation argument. So basically, people who are aware of Austrian economics and creative destruction will understand this intuitively. But for an economy to grow and to remain efficient and productivity to rise, there has to be a certain amount of turmoil. A certain amount of companies have to be going bust. A certain amount of people have to be losing and gaining jobs. There has to be a certain amount of change. And what governments and central banks are doing to companies is preventing that change from happening. They're keeping zombies alive, basically. They're keeping patients on life support. But that means that they can't grow. They can't improve the economy, can't improve their efficiency. You're losing that dynamism and change and increases in productivity over time. And that is basically bad news for our living standards and for GDP growth over time. Another possibility, which is sort of the one that historically I think has proven true, or at least history tells us is the most likely outcome, is that eventually there'll be inflation. Eventually, if you give governments and central banks this much power and a blank check, eventually they'll overdo it, and there will be a devaluation of money. Once you have politicians and central bankers accountable for results, not just with the tools in hand, but actually held accountable for how much GDP and inflation there is, then they're gonna keep pushing until something breaks. And historically, that is the value of money itself. Those are the two sort of predictions or paths that I think are most likely in a world where debt can be rolled over, infinitely and indefinitely. And I don't know which one is more likely and what they mean for investors yet, but those are the two that I've been thinking about.
That does sound like the return to the 1970s. And there've been plenty of people calling for a return to the 70s as an investment thesis for the future, where you as you described, you get that stagflation where the economic growth is not very high, and yet inflation grows and grows, and it's of course a period of great government management of the economy and all of the dysfunction that creates. And it does seem like it does seem quite a compelling argument. Of course, the government intervention in the economy was much different flavor back in the 1970s, whereas now we're looking much more to sort of the central banking roles and the treasury roles in finance as the lever by which the government might control the economy. It does seem like quite compelling when you consider the amount of intervention we've seen, certainly just following the Wu flu crisis. And it's not like that intervention is going to go away anytime soon. As soon as anything goes bad, our tolerance for any kind of economic pain is so low that it just seems like all of those levers will be pulled and brought out all over again.
I think it would just be immensely unfair to pick and choose who gets bailed out and who doesn't. And the ironic case of that is what's happening with the Virgin businesses, where Richard Branson was against bailouts of airlines in 2008, but when it's his one, then he's in favor of them. And you've got basically governments having to pick and choose which airlines are going to survive, and that's a pretty bad situation to be in, where politicians are picking the winners and the losers, because it doesn't allow for disruption, and disruption is what I believe creates economic growth over time.
Yeah. It doesn't seem like the idea of capitalism without bankruptcy, without any form of punishment for failure, and it's just going to stifle innovation over time. If there's no need, there's no actual drive to be a more efficient enterprise. Why bother trying to be more efficient? Why bother trying to innovate in general?
I think we should talk through that, because I think you've highlighted a key point here, which is when a firm goes bankrupt. What basically happens is resources that were allocated to a business model that didn't work get reallocated to a new business model, which has a good chance of working, especially because those assets become cheaper. So a corporate bankruptcy is really just a rejigging of those valuable resources, the warehouses, the machines, the people with the expertise, whatever it might be. And so if you stop that bankruptcy, you get stuck with a bunch of businesses doing something that they shouldn't be doing, that doesn't pay off, doesn't work well. And you can apply that same thinking to the economy as a whole. What you have during a recession is not a lack of economic activity or some sort of decline. What you've got is the economy going through a change where it basically retools or reassigns resources to people who think they know how to use them better. And if you prevent that from happening, then those resources stay with the people who don't know how to manage those businesses and don't provide the economic growth and don't lead to a new phase of prosperity.
Yeah, and that it all does come back to that issue of where is the release valve for it? And as you described earlier, it was in the currency. It certainly does feel like we've reached something of a peak when it comes to the disinflatory forces around the world. It would make sense now that there would be some kind of return to an inflationary dynamic. So, with globalization, of course, you had the global economy of scale, where labor and resources were allocated all through global supply chains in order to create the cheapest products, and that was a great time for the consumer. But of course, with the low cost of the consumer product, that meant inflation was really very low, or it seemed very low in the inflation statistics, at least. It does seem like we've reached something of a peak when it comes to that old globalization dynamic. I'm not, maybe we'll see a different form of globalization going forward. Of course, you see, like with companies pulling their supply chains out of China and then putting them into India, for example. But it does feel like, a change has taken place there, where we're moving from this disinflation at any cost, sort of corporate profitability at any cost, and then moving to one where higher input costs are a sort of a reality of the global economy, which would sort of bolster this argument that we're about to enter a more inflationary phase. When you couple that with the idea that the government is the one that's picking the winners and the losers here, maybe this is the big moment. The Wu flu ends up being the sort of crystallizing event for when inflation finally comes back in some meaningful manner once everybody gets back to work. I mean, what do you think is the sort of timeline for this? I mean, how long does it actually take for government control of the economy to really filter down into economic reality?
It's tough because there's too many moving variables. So what you had in the 70s, to a great extent, was an oil price shock. And we've sort of got the opposite to the oil price shock at the moment. So the thing that I would like to point out is you've got to compare it to the counterfactual. So in that narrative you just had, we had a long period of disinflation. Now, how much stronger would that disinflation have been if it weren't for central bankers trying to create their inflation targets? And it would have been a lot stronger. It's just says basic logic. Now what we're going to have is a reflation or an inflationary period. But the question isn't just what is the CPI doing? The question is what would it have done without all this money printing and all this government spending? And that is the important gap, because that measures how much things are being manipulated, which is what is also in turn measures how misaligned and redirected the economy is being, which is what leads to the stagnation in the end. So inflation isn't how far and above or below zero the CPI is moving. It's actually a question of compared to what. And if you've got a situation where the world's going through a big globalization where everything is getting cheaper, but the central bankers are offsetting it by printing loads of money, then you're missing out on the benefits of things becoming cheaper. But you're also getting a weird economic misalignment. And the way that showed up in the past was in US house prices, financial asset prices, gold. And so in the next round, what is the symptoms going to be? We could be in for another round of stagnation and stagflation like in the 70s, where the stock market went up, but it actually performed extremely badly, adjusted for inflation. You had high interest rates. I don't think that's possible this time around. I don't think there's, effectively, I think there's too much debt for high interest rates to happen, which suggests that the inflation rate could go completely out of control. So it's like the 70s, but there are key differences. And so the counterfactual that you should be measuring against isn't clear.
You say with the you don't think higher interest rates will be possible this time around, but provided that the interest rates lag inflation, so the inflation is much higher than the interest rates that are being set by in the lending markets and by central banks in general. But I mean, provided that the inflation, that debasement of currency is gross enough, surely the high debt issue kind of evaporates in that, right? It's sort of this furnace of inflation that burns that debt away.
Yeah, so the question becomes who controls interest rates and how fast can they move? And most of the important interest rates that we're talking about are the market rates. The interest rates that investors require on companies in order to buy their bonds, and same for governments. So I think those interest rates could move so fast, and that in turn implies falling bond prices, which is another financial crisis. So the point I'm trying to make is that the financial carnage that would be caused by a spike in inflation would be extraordinarily severe. And perhaps that's how that reckoning comes that we were talking about earlier, is that companies can't refinance at the interest rates that are spiking out of control because of inflation. And the central banks only control the policy rates. So the whole game would be up at that point. You'd have investors basically fleeing any fixed rate securities, which is government bonds and corporate bonds.
It does seem like whenever that shock happens, because you are describing what is effectively a shock of inflation to the system rather than anything gradual, right?
I think so. Although it could emerge gradually, but the point being that it would accelerate so fast that it wouldn't be distinguishable from a shock. When you say shock, it implies that there's an external cause. I don't know if that would be. It could be possible that there's an oil shock or some other similar shock, like the Chinese political crisis and the trade war getting out of hand. But the point being that it's built into the situation, the whole thing, the inflation and bond bubble bursting would accelerate so quickly that it would feel like a shock.
It is interesting that we're discussing this sort of return to the stagflationary 70s. And we have had an oil shock, except in the complete opposite direction, right?
Yeah, that's the irony.
Yeah, I mean, it's pretty ironic, I suppose. But at the same time, in the 70s, of course, you had the big sort of currency revolution which began with the US going off the gold standard. It wasn't even with the gold standard per se, but it was off the leaving Bretton Woods and the gold exchange standard to some degree, and the global currency system as a result wasn't tethered to anything. It seems interesting that you did have those oil shocks. You had all this interesting geopoliticking around the world, and of course, it was a great Cold War era, effectively. It does seem like there is some kind of echo in that, but maybe as the oil shock was in the opposite direction this time, maybe there'll be some similar sort of inverse event.
Yes, although if we transition to green energy and that proves more costly than expected, we could get an energy shock there as the world transitions away from oil and into batteries and electricity. So you could see energy prices spike still. At some point, inflation is a measure of the direction of change, and the oil price could quadruple from here in short order. So all of those things are possible. But what we're talking about now is inflation as most people understand it. It's a measure of prices. But inflation is actually all about how much money is being pumped in. It's not a measure of a symptom, it's a measure of a cause. And that's the point I was trying to make earlier, where you got to compare to the counterfactual. So if prices would have been falling, but they are prevented from falling by what I would call inflation, meaning money being printed, then that is a huge effect. But it doesn't show up at all in the consumer price index because that's being kept at around 2% or whatever the price target is. So the measure of interference and what I would call inflation is measured in terms of basically QE, central bank balance sheets. And that's going off the charts right now. What should be happening in the world is a plunge in a lot of prices, not just oil. They should all be crashing, which would then be what spurs a new renewal in the economy. And instead, you've got central bankers maintaining these elevated prices of everything and preventing that renewal and preventing that change from happening. So if you've got the combination of stagnation and inflation, that's when things get really dangerous, right? It doesn't matter as much if you've got some inflation in prices for a good reason, because there's a lot of prosperity happening and people are competing for resources. Great. But if you've got inflation because of central bank printing, prices are rising during stagnation in the economy, then it's a big problem. And it's tough to distinguish between the two at the beginning. The worry is that people just will not put up with the combination of stagnation and inflation. If unemployment's high and prices start rising, as is possible after the COVID crisis, then you've got a big problem. Hitting a 2% inflation target with a 20% unemployment rate is a problem. And if central bankers see the solution as more money printing, well, it's not. It's going to be an increase in the problem.
Yeah, that does seem like a very nasty combination when you think about it. And with the very high unemployment we're now seeing it in the US, it seems very strange that the stock market seems to be sort of cheering it on.
Well, stocks outperform during inflationary periods, as does gold, which is the signal that we're getting that stagflation, or that the market might be pricing it in. The money's not flowing into the money that the central banks are printing is not flowing into a new companies, new innovation, creative destruction is what the Austrian economists would call it. It's flowing into keeping old companies alive. That de-risks those companies, which makes their shares more valuable. If companies can't go bust because the central bank's going to rescue them, that cuts the downside risk. But the money is flowing into speculation and stock markets. There's a reason the Roaring Twenties, which preceded the Great Depression, were called the Roaring Twenties, because it's an extraordinary speculative bubble, an age where asset prices surge without having a good reason to do so, or at least it seems like they don't until you realize it was just an inflationary bubble.
Damn, does seem like pretty bleak outlook when you when you put it in those terms, I must say.
Yeah, well, that's what I always seem to give is bleak outlooks. We've got to find something to be optimistic about. I think you and I, in the upcoming issue of the Fleet Street Letter Monthly Alert, are going to point out some of the few shining opportunities and bright stars out there for investing.
Yeah, indeed, and funnily enough, what we're actually going to be writing about is a repeat of another dynamic that occurred in the 1970s. Funnily enough, and the 60s and the 50s, but still, it was something that was very, very big, very important in the 1970s, and it's something that we've not been hearing all that much about, and people don't seem to be getting so excited about in recent years. But of course, we'll be writing about that later on this month. I think that sums up today's market broadcast, Nickolai. Thank you very much for joining me on it. I think there was plenty of interesting seeds that we've been exploring there. We'll probably go into. I think we'll do this again. Get in some more detail. We could go into things like the misery index as well, as a sort of a measure of this in future. But that sums up today's market broadcast. Thank you all for those who are listening. I hope you are having a good day in lockdown, as much as good as you can get under the circumstances. We shall be back again tomorrow, and I'll see you then.